August 5th, 2024. 9:30 in the morning, New York. U.S. stocks open into their worst day in almost 2 years. No earnings disaster, no Fed meeting, no fresh headline that morning. The trigger came 5 days earlier, 6,000 miles away. Japan's central bank had raised interest rates by 0.25%. That was the whole event. One small move in Tokyo, and American markets had their worst afternoon since 2022. There is a wire that runs from a policy room in Tokyo into every brokerage account in America. This summer, governments began spending billions to keep that wire from sparking again. Here is how it works. Start with a question traders ask every day. What is the cheapest money I can borrow? For 30 years, the answer was almost always the same: the Japanese yen. Japan held interest rates near zero for decades, which made the yen the world's funding currency. The money you borrow, not the money you keep. The trade built on top of it is called the carry trade, and it has 3 steps. Borrow yen at almost no cost, convert the yen into dollars. Buy something that pays more: treasury bonds, stocks, real estate. The gap between what you earn and what you pay is the profit. Stacked over 30 years, these borrowed yen positions run into the trillions of dollars, quietly wired into markets everywhere. And the entire structure has one rule: the yen must stay cheap. If the yen rises, the loan underneath all of it gets more expensive everywhere at once. This year, the rule came under pressure, and it started with oil. A war in the Middle East has kept the Strait of Hormuz mostly closed since late February. A waterway that normally sees about 130 tanker transits a day has been running at a small fraction of that, and oil has climbed toward $90 a barrel. That bill lands hardest on Japan, which imports roughly 97% of its oil, about 3 million barrels every day, and pays in dollars. To get dollars, Japan sells yen. Selling yen pushes the yen down, and a cheaper yen makes the next tanker cost even more. The loop feeds itself. The textbook defense is to raise interest rates and pay the world to hold your currency. Japan has been raising. Rates now sit at 1%, the highest since 1995, but with government debt near 230% of the economy, every further hike also raises the government's own interest bill. The tool exists. Using it is just very expensive. By late July, the yen had slid to about 164 per dollar, its weakest level in roughly 40 years. Then came something not seen since 1998. The United States joined Japan in the market and bought yen. Japan spent an estimated $87 billion in 2 days, and the U.S. Treasury Secretary pledged, quote, whatever it takes. Now add the third piece. Japan is the largest foreign holder of United States government debt, holding about $1.2 trillion of Treasury bonds. And those bonds are exactly what a country would normally sell when it needs dollars to defend its currency. Here is the problem. Bond prices and yields move in opposite directions. Heavy selling pushes prices down and yields up. And that would land on a government owing nearly $40 trillion, paying more than $1 trillion a year in interest, with 30-year borrowing costs already at 2-decade highs. So a different route was chosen. The Federal Reserve runs a lending window built in 2020 where a foreign government can pledge its treasury bonds as collateral and borrow freshly created dollars against them. No bond is ever sold into the market. The limit is $60 billion per country, and the Treasury Secretary is publicly asking for that limit to be raised. Notice the design goal inside that machinery. Defend the yen without a single bond touching the open market. You can tell what engineers consider load-bearing by what they refuse to stress. What this design refuses to stress is the treasury market itself. Quick recap before the last piece. 1. Trillions are borrowed in cheap yen and invested everywhere, and that whole structure needs the yen to stay cheap. 2. Oil pressure is pushing the yen down anyway, and Japan cannot raise rates hard without raising its own government's interest bill. 3. The rescue is built so Japan gets dollars without selling a single treasury bond. Hold those 3 and the rest follows. So what happens if the wire sparks anyway? Suppose the yen jumps. Every borrowed yen position on Earth gets more expensive at the same moment, and every holder needs to do the same 2 things. Buy back yen and sell something to raise the cash. They do not sell what they dislike, they sell whatever sells fastest. That is why a funding shock looks different from ordinary bad news. Stocks, bonds, gold, even crypto get sold together. Correlations that are usually loose snap toward one. Volatility clusters. Quiet phases end everywhere at once, and an active phase begins everywhere at once. Nothing is wrong with the assets. The problem is the funding underneath them. August 2024 was the demonstration. 1/4 point hike in Tokyo. Japan's stock index fell more than 12% in a single session, its worst day since 1987, and US stocks had their worst day in about 2 years. The unwind circled the planet in an afternoon. Now, one caution about the version of this story going around online. It says bets against the yen are at record highs right now. The official positioning data says something more interesting. Speculative yen shorts did reach one of their largest levels on record in late June, roughly 115,000 contracts net short. Then the intervention and the rate hikes forced about half of that to cover within 6 weeks. By mid-August, positioning sat near the middle of its 10-year range. Two honest readings. The visible futures are only the tip of the structure because most of the carry trade never appears in any report, and positioning that unwinds this fast tells you how crowded the exits are. The wider lesson is simpler. Before repeating a viral number, check the data. It is public. So what would an informed observer actually watch from here? First, the calendar. In late August, central bankers gather at Jackson Hole. Then in September, the Federal Reserve decides on the 16th, and Japan's central bank decides less than 48 hours later. Two decisions, one wire inside the same week. Second, the paper trail. The Federal Reserve publishes its balance sheet weekly, and use of that lending window shows up in it. Japan publishes intervention totals at month end. The Treasury reports foreign holdings monthly, so you can watch whether the $1.2 trillion pile shrinks and whether the $60 billion limit gets raised. And because oil feeds the loop, the Strait matters as much as any central bank. So here is the whole chain one more time. Cheap yen quietly funds markets everywhere. This year, the yen came under real pressure. The rescue was designed to protect the Treasury market first. If the yen ever snaps upward, everything gets sold at once. And the public data, not the viral story, tells you how close that is. None of this is a prediction. It is a wiring diagram, and now you know where the junction boxes are. This has been educational analysis, not investment advice. See you in the next one.